And as we just saw, markets are up today with tech stocks leading gains across major North American indices. Our next guest is optimistic about equities this year and believes the earnings outlook remains positive, but is also seeing a lot of divergence. For more on this, we're going to bring in Kai Lam, Chief Investment Officer at JCIC Asset Management. It's good to have you. Thanks for joining us.
Thank you. Thanks for having me.
We are in the middle of earnings season. I'm wondering, first of all, what your impressions are, if there's any kind of key takeaways from certain sectors.
Yeah, I mean, I think the earnings season's been pretty good. We're constructive on the market this year, basically because it's been earnings driven. But we are seeing kind of a broadening out of earnings contributions from a lot of different sectors, and the market is getting a bit more discerning on where the earnings are coming from. But yeah, as you see, the TSX, we're really getting a benefit from areas like gold and cyclicals in the base metals mining. That's been positive.
Apart from Amazon, all of the other major scalers exceeded their earnings estimates this quarter, yet their stock kind of went down after they reported earnings. A lot of that because of that aggressive spending that so many companies are talking about. How do you interpret this trend, for investors if they're looking at the Mag-7?
Yeah, I think because last year a lot of these companies did really well, and because they were the biggest driver for earnings. But at the same time, as their earnings growth started to kind of peak out, and then they also had increased spending on AI. The markets have been focusing on the other areas where the earnings have been improving. I think the market has been becoming more selective when it comes to how to play AI beneficiaries. And so then some of these have not performed as well recently.
Has that changed your view at all for any of the Mag-7 companies, like any of them at all, after you've seen what's been happening in the latest earnings report?
I mean, look, it really comes down to the earnings, and so we like companies like Google, but we're also getting the AI theme from other places. So, for example, we own TSMC, and this company we think is more insulated from some of these concerns because they're a beneficiary of AI spending. They make the majority of semiconductor chips in the world with over 65% market share. And all their customers include AMD, NVIDIA, Apple, Broadcom. It doesn't really matter where the demand comes from. They're probably going to manufacture it. In the meantime, competitors are at a disadvantage to them because the next two biggest players are Samsung and Intel. But operating margin for Taiwan Semi is over 50%, where Samsung is, we think, is around low double digits, and Intel is actually losing money in foundry.
We've seen a lot of these companies adopting AI to improve productivity, even if that's increasing their margins in the short term. Have you seen this yet affecting the labor market, or when do you expect us to start seeing this affect the labor market?
One thing that we have seen is that the labor market has been kind of slow at the same time as earnings has been improving. And we think that trend will continue, where AI is going to help improve earnings and help productivity without seeing that as much upward pressure on the labor market. So that's part of the reason why we're optimistic about earnings, is because of this productivity improvement. But from a labor market perspective, it'll kind of slow the pressure down on that side.
How would that affect the markets if you see that impacting the labor market?
I think the market is going to be more focused on the earnings. And so as long as the earnings and productivity improves, that's what the market will focus on.
Okay, let's look overseas now, because we saw the Japanese stock market rising today after the Prime Minister secured a majority vote. What do you make of what you saw in the markets overseas today in the Asian markets?
Yeah, so there was a snap election that completed yesterday, and the Prime Minister, Takaichi, she got a supermajority. And the market was very optimistic on that, because that means she'll be able to implement her different policies. One of the things that she wants to do is she wants to cut for 2 years the 8% sales tax on food to make life a little bit more affordable there. But she's also looking to invest in government spending for about 17 different priority sectors. And that includes areas like semiconductors, AI, nuclear, and she also wants to spend more on defense and security. So that's gotten that market a little bit more excited because of the increased spending that she wants to do.
Do you think investors, though, are underestimating the potential negative effects of that?
There is potential negatives because, for one, interest rate policy is not matching up with her view because they're increasing interest rates, to try to keep inflation down because inflation's been elevated. And so that'll be interesting because they're a bit conflicted. And then there's also concerns about how do you fund that spending? And that could put pressure on raising bond yields and need to issue debt, in which Japanese debt's quite high. It's government debt is almost 250% of GDP. So that would be something that we have to factor in.
Okay, before we wrap up here, let's take a look at some of your stocks that you like. You like TSMC, which of course we talked about earlier. Also Dollarama. What appeals to you about these two?
So one of the things I like about Dollarama, one of the things that we've seen, when the market's been a little bit more concerned about AI spending, whether it's a bubble or not, you're seeing some rotation in defensive companies where you're not going to see that AI disruption. With Dollarama itself, it's a growth company that's all highly defensive. And they pretty much benefit from any economic environment. When the economy is slow, people trade down for looking for better value. They also can still grow 60, 70 stores every year in Canada. And then they have other growth drivers. They have 60.1% interest in Dollar City in Latin America. And a bit longer term, they're turning around operations in an acquired reject store in Australia. And then later this year, we're going to get a lot more probably volatility centering around U.S.-Canada trade relations. But this one is kind of insulated from that as well.
Okay, that's all the time we have. Kyle Lam, Chief Investment Officer at JCIC Asset Management. Appreciate your time. Thanks so much for joining us.
Thank you.